partnerships. You might have probably seen them somewhere in the question banks. For those of you who have been trying to look at the question banks, you might have heard of them. You might even be in a partnership and you're not sure, or you don't even know that you are in a partnership. So usually when more than one person or when two or more people come together to join forces for a particular, come together with the same motive to maybe to make a profit or achieve a particular goal, they form some sort of alliance, and this alliance we call it partnership. And we have seen businesses probably that have more than one owner. You find that they're like two bosses and they are partners, business partners. You've heard the word, you've thrown it all around. So we are going to see how we treat accounting for this kind of businesses. We have looked at accounts so far. We have looked at accounting for a sole trader. That's a person who owns a business alone. We saw what happened. We have looked at manufacturing, where we are converting raw materials to finished goods. We saw how we adjust those numbers. We have looked at what's the third thing we have looked at? We have looked at not for profit. We have seen how the societies and clubs operate and also account for their resources. So today we're going to see how partnerships account for their resources as well. So I'll go straight to our notes for today. This topic is quite lengthy, so we may not, this time around, we may not handle it in just today, but it's important that the foundation that we are going to lay today, you understand it, because it's going to build onto the other blocks that we'll add in the next lecture. So we'll look at what basically a partnership is, the definition of the partnership, the partnership agreement and funds employed, as well as appropriation of profits and adjustments in partnerships. So usually partnerships are very common to do when it comes to things like medical practice, of course, also normal businesses, schools. Usually I've seen people who partner for schools. It could be for any kind of business, really. It could be for any kind of business, as long as the minimum of the partners is 2 and the maximum is 20. When you have more than 20, then it ceases to be a partnership. It becomes a limited company that we'll look at, I think, probably next week. And so it will be you register it, of course, differently, and that means that you will account for it differently. So even you as an accountant, by the way, it's very important that when you're doing books for a particular company, you understand whether it's a private company or it's a public company or it's a partnership or it's a sole tradership. You need to know what its legal status is, because the legal status usually defines how a company will report. So we're saying that a partnership is a type of business arrangement which involves the combination of 2 or more individuals, usually known as partners, with an intention of making profit. Normally, there can be a minimum of 2 partners and a maximum of 2 partners. If you're in a relationship, yes, you've called your boyfriend stroke girlfriend a partner, but if you're not together with an intention of making a profit, then you're just in a normal relationship. But if you're together and maybe you actually even truly come together to make a profit, then you may be in a business. You never know. But if one of you is stealing from the other, that's not a partnership, that's just theft. So usually before for a partnership to come into place, it's legal or it's mandatory that they should have a partnership agreement. Just like when money is involved, people get a bit difficult, or you need to have clear rules on how you run the business so that you avoid issues of so that you manage each other's expectations. So usually we come up with a partnership agreement or a partnership deed. It's very, very key that you have a partnership deed as a partnership, as a business that is coming up in form of a partnership. This deed is a document basically that discloses how you're going to interact with each other, how you're going to relate with each other on different levels. So we're saying it's a written agreement in which the terms of the partnership are set out, and in particular, the financial arrangements as between the partners. So some of the terms the partnership deed will cover include capital, whereby each partner puts in a share of the business capital. If we say we're going to start a business of 50 million, and maybe each of us has decided to bring in 25, it needs to be clearly shown in the partnership agreement that each of us has brought in 25 million. If you've brought in 5 million and your friend has bought 45, don't wake up and start saying you brought in more. The deed will clearly show how much each partner has contributed. The profit sharing ratio. Of course, you come together with an intent of making a profit. And so at the end of the day, you need to be able to also share it accordingly. So usually the partnership deed will also have a ratio in which you will share the profit. It could be a percentage. We could say that each partner is going to get maybe 20% of the profit. And so if you're 5 partners, 20% times 5, that's 100%. If we say maybe you're 2 partners and you decide to go half, maybe you can say that each partner will get 5%, sorry, 50% of the profit. Or you could express it in terms of ratios. So you have to be keen. You have to be keen. I hope you still know how to do your ratio knowledge. You have to be keen on how you use your ratios. And also how you appropriate the profits. So the next thing that the deed has to show is interest on capital. Interest on capital, partners were saying may agree to pay themselves interest on capital they put in the business. So for example, we are a class of 11 people, or we are a class of 10 people, and all of us decide to bring 10 million to set up our chicken business of 100 million. And so we can decide to say that every year maybe we'll be earning 2% of the interest that each one will be earning 2% interest of the capital that each one of us has contributed to the business. So in addition to the profits that we make, we will also be paying ourselves 2% of our individual contribution. So if I brought in my 10 million, I also know that at the end of the year, I will be paid, because I'll be paid 2%, which is it should be about 200,000 or 20 million. Hopefully I'm right. So because at the end of the day, a business is a separate entity from the owners. You have to always remember that a business is a separate entity from the owner. So these people are putting in money in the business is working. You take it like a business is its own person. This business is working, and it will give them back either money, or it will give them either money in form of profit, or in form of interest on capital, or it could give them a loss. But if it's working, it has to bring out a result, which could either be a loss or a profit. It just won't be there, and it's just not bringing anything. So in a partner, we're saying that in the absence of a partnership agreement, the interest on capital is not allowed. That means that if you don't have that document, if you don't have the partnership deed, or what we call the partnership agreement, you should try as much as possible as partners not to give yourselves interest on your respective capital thresholds. Then the deed will also show partners' salaries. Partners, we are saying, may agree to give themselves salaries. They may decide to pay themselves. They're like, you know what? Maybe we will be paying ourselves according to our profit ratio. And if we are getting equal, maybe I can be paying myself 5 million, and the next person will pay themselves 5 million. So they are not we are saying these are an appropriation of profit and not an expense in the profit and loss account. We shall see this later. But when we are accounting for partners, or when we're accounting for a partnership, we will determine the profit of the partnership. After that, we'll appropriate that profit. We'll give that money to its owners. And so sometimes the owners of the business may say, hey, you know what? Let's also be paying ourselves salaries. These salaries are different from the salaries that you're going to include in your P&L. Why? The expenses that you incur in your P&L ideally are expenses that you incur because they are expenses that you've incurred to help you achieve that particular that particular profit that you've gotten for a particular year. So if let's say this year I have gotten a net profit of 10 million, all the expenses I incurred, maybe we were selling our chicken, maybe we transported the chicken, we fed the chicken. All those expenses have to be related to the activity in hand. Every other expense out of that, of course, we know will probably not be business expense. But if it's, of course, directly related to the business and it's directly related to the activity that we are doing, then it will be an operating expense. But for the partners' salaries, whether the partners work or not, the business will make a profit or it will make a loss. So there is no, it doesn't make sense for us to add their salaries as part of our operating expenses, but rather we will first wait to get the net profit as per the operating expenses, as per the expenses that helped us get to that profit figure, and then after that we will then pay the partners the salary. So that means that if we've made a loss, there is no reason for us to pay the salaries for the partners. Imagine us paying the partners salaries before we actually declare whether we have a profit or loss. It's like picking money from the business and now saying you have made a loss, yet you yourself, you ate business money that it had already produced. So it doesn't make sense. I hope you're seeing the logic behind that. And then we have drawings. It should also be included in the partnerships deed. Partners may draw out their share of profit from the business. There could be an interest charged on these drawings, and the law prohibits drawings in case there is no partnership agreement. This is also a sensitive thing. You can't just pick money. More so if there is no agreement that is going to guide on how you pick money and what happens when you pick money. Your friend will imagine us, like we are now, our class has increased to 12. We are running our chicken business and we hear one morning that Peace has picked 500,000 without telling any of us. We will all look for Peace and ask her why she's picking money from the business. But rather, if we have a deed that clearly dictates that when maybe someone picks money, we shall charge them a 10% interest, then we need to, sorry, excuse me for a second. I need to change something here. Okay, so I'm sorry for that. Kindly excuse me. So, like I was telling you, it's very important for us to have a partnership deed or a partnership agreement that is going to also clearly tell us what is going to happen when what is going that is clearly going to allow our business to, it's going to allow people, our partners, to withdraw money, and it's also going to tell us what happens in case they withdraw money. Sometimes we will tell them that maybe the partners may decide and say, if you withdraw, if you make a drawing in the business, then we'll charge you maybe a 5% interest. Sometimes I'll tell you there is no need for interest on the drawings. And you as an accountant, you have to look out for these policies so that you know how to report. So another thing that did will also show loans, like to give status on how loans will be treated. So if a partner makes a loan to the business, that is usually as it's usually different from a capital contribution, then the interest on loan will be an expense in the profit and loss account in the same way as interest to any other partner. So what this means is that sometimes we might have started a business, for example, with a capital of 10 million. But then something happens and we find out that maybe we need to clear some stuff at the border. We need to clear maybe some of the things we are coming to sell at the border, or we need a car for the business, or the business maybe needs some working capital, maybe needs like some cash. And so one of the partners goes is like, you know what, let me give you 5 million, but you will pay me back. When I'm saying, well, let me give you, I'm not saying I'm giving to the other partner. I'm giving the business 5 million. So, and the partner says you will pay me back. This kind of loan, we shall take it just like, we will take it as if the business actually went to the bank and picked a loan. So the partner will give a loan to the business, and it may even have an interest. So just like we were treating loans in the previous examples, so we do for this particular incident. When a partner gives a loan to the business, we will charge the interest just like we've been charging for normal bank loans. If let's say it's 10% of the 5 million, that will be 500,000. We shall show that 500,000 is a finance cost under our profit and loss account. So in addition to that, we also have to clearly stipulate, we clearly have to show the funds employed, that is the capital that has been invested in the business. So I talked about earlier on, we're just going to elaborate more on it. Now, what we have done sole proprietorship, we just saw how to get their net profit. We did our manufacturing. We saw that we are supposed to first get a manufacturing account first, feed it into the trading, and also get our net profit or loss. We did our sorry, I keep on forgetting it. We did our not for profit. We saw that it will either have an income over a surplus of income over expense, or will have a deficit or will have expenses more than the income. Now here, because people keep on putting money, it's a business where people put money, they invest, they pick money, they give loans to the business, they want to pay themselves salaries, we have drawings. All these things that I'm talking about will usually affect the capital account. Remember, we have in our liabilities, we have been drawing up here. We have been drawing up in our, when we were doing our accounts, we have always drawn up our liability and equity. And we have always started with our capital account. Then we have moved on. In case there are drawings, we have shown them there. So far, this is what we have been doing. Now, with partnerships, of course, then we've also added retained earnings. This one has been, we have been showing it in summary because this is usually, it has been one business or a manufacturing. We have not really looked at the context of the share capitals and whatnot of manufacturing. So with partnership, the capital, you find that it's owned by 2 people or more. So if it's our class, and we are now 12 people, and each one of us contributed 100,000, maybe we started our small chicken business, I will have to show that 100,000 12 times. So it will be 100, 100, 100, 100 times 12. I'll show and I'll show the name. Of course, at the end of the day, our business is worth 1.2, but I have to break it down and show that. And then in case there are drawings and maybe Faith picked the 50,000, I'll show that we had drawings of 50,000. And then maybe in case we have any retained earnings, we will come and show that there. So now there are very many adjustments that you have to do before you even come to our statement of financial position when it comes to the capital account. Sorry, when it comes to the statement of financial position. And that's why we have a capital account, okay, which is going to help us make these different adjustments. So now the capital account could be recorded in two ways. You could have one, what we call a fixed capital account. A fixed capital account, for it, you just have your capital, you get your capital account, you get your full capital account. I'm trying to get my pen. You will have your full capital account, you debit it and credit it, and all the adjustments that you will make. So in case, sorry, I can't try to draw. So in case this is your T account, for a fixed capital account, okay, all the adjustments that you will be making will be in one account. Okay, so when partners bring capital, Faith brings, Peace brings, Alina brings, JB brings, every one of us brings, we will come and show that there. So when one of us picks money, we will come and show that our capital is reducing, because remember, drawings reduce our capital. When we have retained earnings, we will come and increase in the same account. That's why we call it fixed. It's one account and it just holds so many movements. That's one type of capital account. Another one, it's called a fluctuating capital account. This one, what will happen is that we will introduce another account called a current account. At the end of the day, they all monitor capital, but we will introduce another account called a current account. So we'll have a capital account and a current account. A fluctuating account records, we have a separate capital account and a separate current account. A fixed capital account has only one capital account that has all the movements happening in just one T account. Fluctuating, we have two. Now, what happens in the two? We have, of course, our capital account. Okay. This one will fixed, we will only put the initial money. Everyone who deposited 100K, that will be it. 100K times 12, we will list, of course, everyone's name, because we have to show different happenings for each partner. Not all of us will do the same things. I may decide to make a drawing. Faith may decide to give a loan. JB may decide to add more capital. It may be very many things. Another person may decide to leave. So this T account is kind of a summary that just helps us know, it breaks down each partner, so that in case any business is happening with any individual partner, we can still be able to record it without having to use very many different reports. So for the fluctuating capital account, we'll have, first of it, I've told you to have two accounts. To have a capital account of its own, and then it will have a current account. The capital account will have purely the money that people invested. And then the current account will have all the other movements, every other movement that can affect a partner's capital. So for now, the movements that will affect, for now, at least for today, will basically be drawings, loans, salaries, that kind of thing. But eventually, even a partner may leave. We shall see how we adjust that. We may onboard another partner. A partner may leave at the same time we onboard. So we shall see how all these movements happen. But ideally, all those movements, in case we are using a fluctuating account, then we shall record them in the current account. So you have to be keen. Usually the examiner will tell you how to calculate this capital. He will either tell you use a fluctuating method or you use a fixed capital account method. So back to the notes here. When a partnership is formed, each partner puts in some capital to their business. These initial capital contributions are recorded in a series of capital account, one for each partner. Like I said, you we list the names. So, and then in addition, each partner will have a drawings account and a current account. A current account is saying it's for profit retained in the business of the partner. That's why I'm saying usually a current account will have movements. So today, this year you make profit, tomorrow you may make a loss, the other day you make a profit. Those are movements. And we're saying a current account, it's sort of a capital account which increases in value when partnership makes profits, and falls in value when the partner makes drawings out of the business. That's why I said it first, it just keeps on moving. So what's the difference between a capital and a current account? The balance, one of the first difference, the balance on the capital account will always remain static from year to year, while the current account will fluctuate up and down. This I've already explained. Partners receive interest upon their capital current account. This one, I think it also, that is in case partners have decided that they'll be earning interest on their capital, then it will be the capital that will be affected. Current, remember, is having movements, it's having profits, it's having drawings. So you're not going to charge interest on drawings that you don't know yet. You're not going to charge interest on profit that you don't know yet. But you can say that we shall charge interest on capital because you started the business when you had that money. So you know what the capital is, and you know you can always plan. Drawings are treated as in sole trade, only that at the end of the accounting period, each partner's drawings are cleared to his current account. So here, unlike sole trader where it was just one person, we're just making a summary because it's one person. Here, it's more than one person. There are two or more. So we have to have an individual account for each of those partners to show. So if you withdrew, let's say we are in our business here, our small business, we have all contributed 100,000 to make 1.2 because we are 12. We have started our chicken business, and now you think because we are many, you come and withdraw 95,000. My friend, you've eaten your whole capital. You only have 5K left as part of our partnership. That means we can even easily buy you out. So we clear drawings to each individual's account so that we avoid situations of people coming to withdraw almost all their capital or even their friend's capital. You find someone wanting to withdraw 150,000, yet they only contributed 100,000 to the business. That is just theft. It doesn't make sense, and it's not right. So what are the entries that the double entry that we make when we have movements in the capital, in the current account? Will there be, in case of drawings, will debit the current account of partners and will credit drawings account of partners. The current account, just like how we have been treating a capital account, all the double entry rules are the same. The current account also increases when you credit it and it reduces when you debit it. Just like a capital account, capital increases when you credit it and it reduces when you debit it. Same double entry principle, because at the end of the day, they're still just a capital account. And then we also have interest on partners' loans. We're saying these interests are credited to the partner's current account. That means that when you give, if let's say JB gives us a loan as a business, he adds us an extra 100,000. And we tell JB, we shall give you back an extra 10%. JB is going to earn more money than all of us because JB, yes, he has given us a loan of 100,000, but we shall pay him an extra 10%. So we shall pay him an extra 10K that everyone else will not have. So we will increase JB's current account. How do we increase JB's current account? We will credit JB's current account. So the interest on loans from a partner, they are accounted for as an expense because yes, the business, indeed JB gave the business 100,000. The business is using that 100,000 to make more money, to make profits. Maybe they used it to pay salaries of our chicken feeders. So that 10,000, yes, it will show we will show it as an expense in our profit and loss account, but then also we will the double entry to that will be it affecting the partner's accounts. we shall not appropriate it. You will see, it may seem a bit confusing right now, but you will see, you will try to get what, you try to appreciate what I'm doing when we go through an exam type question. But take time, I sent the notes on the group, take time to just look at those performers so that you internalize them and you know how to be recording these accounts, because the performers are they are, of course, they are the blueprint on how we report for such accounts. So appropriation of profit, we have something called appropriation of profit in capital in partnership accounts. You see, so we have our chicken business. We brought in 1.2. We have bought birds, each bird at 3,000, and we are very good business people. We are selling we are selling the bird at 15,000. When we put in all the other expenses, maybe each bird we incurred an expense of 2,000, giving us a net profit of 10,000 per bird. Let me assume that we bought 120 birds. So we have our net profit of 10,000 per bird. Okay, we bought 120 birds. So we have actually made, this is just very, very idealistic. So we have made our profit of 1.2, net profit of 1.2. We are 12 people as we are in our FA class. So what is going to happen is that if we all equally, we may decide and say, since we all equally brought the same amount of money, leaving aside JB who gave us a loan of 100,000, we brought in capital, all of us over 100,000. We could decide and say all of us are going to earn profit according to how much capital we brought in. So that means that you will get that profit since you have said it's equal. Okay, since all of us brought in 100,000, we are 12. It means that we each brought in an equal amount of money. So what you could decide and you do, you could say, since we all brought equally, we will all share our profit equally. So that means that we will get our 1.2 profit when we divide by the total number of people that we are. So which means that each person, each partner is going to walk away. Excuse me for a second. Apologies for that. So, like I was still saying, it means that each one of us, at least, whether you gave out a loan, whether you did drawings, at least each one of us will know that we are taking home 100,000 from our profits. So now, there comes those of us who took drawings, in case maybe partner A took a drawing of 50,000, we shall show in their account that they took a drawing of 50,000. So if they were supposed to receive 100,000, but they took a drawing of 50,000, we shall adjust the account to show that they took a drawing. If the same partner is the same one, JB was the same one who took a drawing but also gave us a loan, and he earned a 10% interest, which is equivalent to 10K, we shall show in his account that he earned a 10% interest. So any kind of movement that may be concerned, that may concern these different partner accounts, we shall show it in those either if we are using fixed, we shall show it in the partnership account. If we are in the capital account, if we are using fluctuating method, we shall show these movements in the current account. And so at the end of the day, we shall know, for example, just a sneak peek at just one partner. The one partner earned the net profit of 100,000, but had drawings of 50K. and they earned net an interest of 10,000, meaning that his value has only increased by 60,000. It doesn't necessarily mean that because you've earned this 60,000, we should give it to you. Yes, it's your money, but you may not decide to pick it out of the business. You may not decide to cash it out. And so what is going to happen? It is going to increase your value. So if we are going, maybe you are closing the year, means that we are going to carry forward the 60,000, and in the next period, if it's your current account or if it's your balancing account, the next period your capital is going to show an increased value of 100,000. So of 60,000. So it will be 60,000. The new value will be 60,000 plus the original capital, which is 100,000. Capital doesn't change. Of course, yes, we made drawings of 40, but we still, we made drawings of 60, but we still had a net profit of 100,000. So this will be it. We shall look at it much better with the exam question. I just want us to understand the concept behind it. It may seem very, very new to you. That's why I'm trying to simplify it as much as possible. Okay. So the partnership appropriation account, we are saying the net profit of a partnership is shared between them according to the terms of their agreement. Not all the time will we be sharing equally. Sometimes people want, like when I told you, you may start a business of 50 million and someone brings 5 million. The person who brings 45 million is not going to allow to have the same profit margin as you who brought 55 million. That's just not right. So you find that you will have profit sharing ratios. In the event that you don't have profit sharing ratios, you may have a tricky question why you don't have profit sharing ratios. It's extremely rare. But in the event that something like that happens, then you would do the math. For example, we are saying there are two partners, one brought 5 million, the other brought 45 million to make up a business of 50 million. How shall I know how much profit who gets? We could say that the question could tell you that profit appropriation is as per capital contribution. That means that we are going to appropriate profit according to the capital contributed. What we shall just do, we shall just get percentages. We shall get 5 million or 50 million, convert that into a percentage. That should be 1 out of 5. That should be 0.2, 20%, I want to believe. I hope my math is right. 20%, and that means that one person has 20%, contributed 20% of the capital, and the other person contributed 80%. So this makes your allocation, of course, and now it makes it easier. You just get your 20% times the net profit. That is how much that person will get. And also, the same thing will happen for the other party, 20% times the net profit. So that is what appropriation is basically all about. It's just basically allocation of profits to the different partners. You have to be keen, just be keen and also be confident in these appropriation figures. You can never know. They may give you percentages, they may give you ratios, they may give you a question that is going to determine how much math you know. So just be ready for anything. Okay. So the accounting entries in this regard, when we appropriate, whenever we're appropriating, remember we appropriate after getting a net profit. We shall debit the profit or loss with the net profit carried down, and we shall credit the profit or loss with the net profit brought down. So, and then after that, we shall debit our profit and loss appropriate account with a net profit brought down, and we shall credit our current account of each partner with an individual share of profits for each partner. We shall be looking at this in just a short while. So this is just steps in how we are going to share profit. We will first of all we establish how much the net interest is. Will then establish if partners agree to pay interest on their drawings, and then in case and then after that we shall debit our current account and we shall credit our appropriation of profit account. Then after that, we shall appropriate interest on capital and salaries first, because both of these items are under appropriation of profit and not expenses in the profit and loss account. Thereafter, we shall get the residual profit, that is the difference between the net profit plus any interest on drawings and appropriations of interest on capital and salaries shared out between partners in their profit sharing ratios. After that, we shall get each partner's share of profit and we credit it to his current account. Thereafter, step 6, we're saying the balance on each partner's drawings is debited to the current account. So we're going to just look at the pro forma, what those steps are telling us. After we've gotten our net profit, just like when we were net profit, we shall use the same steps we have always used. Sole trader, gross profits minus operating expenses or any other expenses, we shall gives us our net profit. So after we've gotten our net profit, we shall add the interest on drawings. So people withdraw money from us and then they paid. You withdrew maybe 10 million, but you paid back 11 million. So that extra 1 million is something that is something that has to be shared amongst the partners. It's not going to contribute to your profit because you're not making business out of drawings. No. So it is extra equity, basically. It's just extra money for the partners. So that extra 1 million, we shall share it among the partners. In case we have 3 partners, we shall share it according to the profit sharing ratio. And then after we have gotten our net profit plus our interest, we shall remove the partners' salaries in case there are those partners that are asking to be paid. After we have removed the partners' salaries, we shall also remove the interest on capital. That is it's going to reduce the money that the partners are supposed to be receiving. And then after that, we will be able to now get the residual profits. So that's like the typical net profits. Those typical net profits are what you're going to now allocate to the partners according to their profit sharing ratios. So this is the pro forma for the profit and loss appropriation account. The first one is the same as the second one. This is just now how a T account looks like. Usually this is the easier version to follow. This one is usually the easier version to follow. But you're going to read through those pro formas and decide which one is much easier for you. And in case the examiner asks for one format, which is very rare, then you have to use that. But just look at both of them and decide which one is better for you. Usually I find this cascading one to be much easier for you to remember than the T account. But then again, the T account will help you in case you have different accounts that you need to work with. So it is up to you. Same thing here. We shall have our net profit brought forward. It has a normal credit balance. The appropriation account has a normal credit balance. So we will have our net profit brought forward. Anything that increases the capital account, we shall add it there. Then we shall get our drawings, show them accordingly. Interest on capital, partners' salaries, those will reduce our ideally they will reduce our profit. Interest on capital, we shall also add it there. And in case interest on residual profits, we shall allocate accordingly. And then, so ideally, this residual profits will usually be the balancing figure when you have added up these other items up here. Remember, I told you we show each partner's account individually. This is what I meant. For example, you're seeing that interest on capital, we are writing down partner 1, 2, and 3, and we are showing the money for those partners. If the partner didn't have any money, then we wouldn't show the money there. So that is how a profit and loss appropriation account looks, both in the T format and just in the cascading format. Then the current account. So in case you have like a fixed You have like a fluctuating, you have already done your capital account. Your current account will look like this. These are the items the current account has. Of course, it also has a normal credit balance. In case you have a loan interest, it will add it there. In case you have an interest on capital, we will put it there. So it is basically a double entry for this side. Interest on capital has been brought here. Residual profits have also been brought there. Interest on drawings has been brought on the other side. Current account has been also brought on there. So it's basically a double entry for profit appropriation. What I'm trying to say is that the profit appropriation account feeds into the current account. So you can't do one without the other. We're going to attempt the exam type question that I sent you the group. Debbie, Martha, and Samson. The question is saying Debbie, Martha, and Samson. Sorry, I'm so sorry. Debbie, Martha, and Samson are in partnership trading as DMS garments. They share profits and losses in the ratio 4:3 respectively. The moment you hear the word respectively, you just start counting. Debbie 4, Martha 3, Samson 3. Below is the partnership's trial balance as at 30th June 2020. That means that their year starts on 1st July 2019. The capital accounts, this is what we have for the capital accounts. The current accounts, this is what we have. So now another thing, when you look at a question like this, automatically the fact that they've given you capital accounts and current accounts, you know that it's going to probably be a fluctuating, sorry, it's going to be a fixed capital, it's going to be a fixed account, but unless the examiner tells us otherwise. So leasehold premises at cost as at 2nd August 2019, we have that much. The moment I see the word leasehold, I know that I'm going to amortize at one point. Furniture and fittings, equipment, inventory, opening inventory. Remember, I noted immediately they told me the year ended on 2020, June. I noted that the year, that means that the year opens on 1st July 2019. When you put that, when you make a mental note of that, it's easier for you to know these things like inventory. You can now know that this is our opening stock. Sales and purchases, employee costs, operating expenses, admin costs, accumulated depreciation, furniture and fittings, equipment. This is for the accumulated depreciation for those items. Additions and alterations to leasehold premises, we have that. Professional expenses, we have that. Drawings, Debbie withdrew that much, Martha withdrew that much, Samson withdrew that much. Cash and bank, well, this is what we had. Provision for doubtful debts, we provided for 6.5. Trade payables and receivables, this is what we had. You see, these questions, they just give us one line for two things. These are payables, which are assets, which are liabilities, receivables, which are assets. And here they've just put this. One is on the debit, one is on the credit. So it's up to you to know that a liability has a normal credit balance. That means that payables will probably be 481. Assets have a normal debit balance, which means that receivables will be 267. Same thing I saw also with sales and purchases here. We know that income increases on the credit side. So income increases by crediting it. That means that the sales are the 5.7, purchases, because money is going out and it's an asset to our business, we are debiting it. So the 3.6 will probably be the asset. Practice your double entry so that you don't, it's very, very painful to interchange something when you know the whole concept and you could have easily balanced the number. Additional information, they're telling us that inventory at 30th June 2020 was valued at 572 million. Then the partnership agreement provides that partners are credited at the end of each year with 5% on the balances of their respective capital accounts at the beginning of each financial year. We shall look at what that means. No interest is charged on drawings. Professional expenses were in respect to acquisition of leasehold premises. Employee costs include the following monthly salaries paid to the partners. We shall look at that and what it means. On 30th June, operating expenses outstanding and admin costs paid in advance amounted to 32.5 and 31.2 million respectively. By now, you know the treatment of advances and accruals. Included in operating expenses are returns inwards of 5.6 million and returns outwards of 9.3 million. Bad and doubtful debts are treated as operating expenses. Bad debts of 10 million are to be written off, and a provision for doubtful debts of 5% per annum is made. We shall see how we treat that. Leasehold premises are to be amortized over a period of 5 years, while depreciation of furniture and fittings and equipment is at the rate of 10% and 20% per annum, respectively. A full year's depreciation is provided for in the year of acquisition and none in the year of disposal. I know you still remember this as per our lecture in NCA. Required. Prepare the following in the books of DMS garments for the period ending 30th June 2020. They want us to prepare the statement of profit or loss and the partner's current accounts. So you see the statement of profit or loss is 13 marks, the partner's current account is 7 marks. If you feel you're very time is going and time is up and you're not sure to attempt the fourth number, you know that even with your 13 marks, at least you know by now you can try to get them, because like I told you, we'll use the normal formula that we've been using for our profit and loss, and then we shall appropriate after getting our profit. The partner's current accounts are fed into by information that we shall get after appropriation. And we can only appropriate when we know whether we have a profit or loss. You're not going to give people money when you don't know if you've made a profit or a loss. Do we have any questions so far before we go into our answer? Amortization is like depreciation. It's basically depreciation, but depreciation for non-tangible assets. For non-tangible assets, we don't call it depreciation, we call it amortization. That's the only difference, but the formulas and everything else is the same. The concepts are all the same. Okay, let me know once you see my, you should be seeing my Excel. So let us attempt our question. We are going to determine our profit first or our loss. We will go. We shall create our titles as usual. Our levels of precision. Okay, so we know that we always start with our sales. We start with our trading account. So how much were our sales? The question shows us sales were 5.78 millions. So I'm going to come and show my sales being 5.78 millions. Did we have anything like sales returns? Please let's try to participate that we are at par. Did we have any sales returns? I think I saw something. Did we have any sales returns, class? We have a question in our groups, in our group. When you look at the question, do you see any sales returns? Please feel free to unmute yourself. Yes, Fred, do you see any sales returns? Okay, thank you, Peace. It is saying it's 5.6 million. Let's go to the question and see. It should be there because I remember reading it, 5.6. I saw something to do with returns here. Included in operating, we have returns inwards of 5.6. Yes, so we have returns inwards of 5.6. That means that people bought and they came back and they brought some of those things back. So we're going to show our 5.6. That means that our sales reduced by 5.6. What does that make our net sales? How much is our net sales? When we get our sales minus the 5.6, how much is our net sales? How much are the net sales? How much are our net sales? Okay, 5.7. Let's see, 5.7. 5,779,779. Okay, thank you, Majibu. So we now have our net sales. We are going to next get our cost of sales. We know our cost of sales is equal to opening inventory plus purchases minus closing inventory. That's the basic. So how much is our open inventory? I'm going to go back to the question and see. Might have mentioned it up here. Opening inventory is 546. 546, I'm going to add it there. Of course, plus we add back our purchases. Purchases are worth 3.6 million. We have seen returns inwards, but this question also has returns outwards. They're telling us that the returns outwards of 9.3 million. So we bought also stock and we returned some stock back. We returned stock worth 9.3 millions. When we add that up, we should have our figure total purchases to be 4.1. And then of course we shall remove the closing stock. Closing stock, closing stock inventory as at 30th June was valued at 572 million. So I'm going to come and show my closing stock being valued at 572 million. That is going to leave me with a total cost of sale value of 3.6. When I get my net sales minus my cost of sales, I should be able to get a gross profit or a gross loss. So someone's help us subtract the 5.7, the net sales minus the closing stock, and tell us whether we will make a profit, a gross profit, or we will make a gross loss. Okay, profit of 2.1 million. Thank you. Thank you, everyone. We'll have a profit of 2.17 million. So we have gotten our gross profit, just like the pro forma we've always known. We now get our operating expenses. Okay. So what are our operating expenses? Let's go back to our TB. Capital account, current accounts, equipment, inventory, employee costs. This should be part of it. So we can start with our employee costs. The total employee costs are 832,000. We are going to come to our notes and see if there is anything that is affecting employee costs. Partnership agreement agrees that partners are credited at the end. No. I saw a note, employee costs include the following monthly salaries paid to the partners: 6.5 million for Debbie, 3.9 for Martha, and Samson 3.2. I told you the partners' salaries are not included in our P&L, so we're not going to show them. So these are monthly salaries, but we are calculating expenses for the whole year. So what we are going to do, we are going to get their total monthly salaries. Let me just get a schedule here. Debbie is paid 6.5 million. The next person, Martha, is paid 3.9 million. $3.9 million. I'm abbreviating it, cutting it down to thousands. And then the next person, who is the next person? Let's see. Samson is paid 3.25. So 3.25 million for Samson. This is per month. So we need to, they have told us that the employee expense includes this money. This when we add it up, when I add it up, I get 13,650. So every month these partners are paid this much money. But remember, we say that partner salaries are not included in the P&L. So we're going to get this monthly salary, make it annual. We're going to make it annual by getting the 13 times the 12 months, which will give us 163. So for us to get the actual employee salaries, we have to remove these 163, which is a partner's salary. So I'm going to come back to my notes and see how much my employee cost was. My employee cost was 832. So from 832, I have to remove the partners' money. 832,000. So I'm going to subtract. I'm going to subtract this 163 partners money from the 832 to get the net employee cost. So let me add that to my operating expenses. It will be 668,000. So moving on, we look for the next operating expense. We have looked at employee costs. We've finished that. The next, they're telling us we have 587 for operating expenses. Let's see if there is any adjustment that we need to make. Employee costs, we have done that. On 30th June 2020, operating expenses outstanding and administrative costs paid in advance amounted to 32.5 million and 31.2 million respectively. Operating expenses are the ones that were outstanding, and they're outstanding by 3.25 million. We know by now that when we have an accrual or when we have an outstanding balance, we just add it back. So I'm going to get my I'm going to again go to my notes. I'm going to go to my notes, get the total of operating expenses, which is 587 and 600. So let me come here, 587, 600. That is my total operating expense. They've told me that I had an outstanding of 32.5 million. I'm going to add that 32.5 million here. Is that so? Tell me I had an outstanding of 32.5 million. So the next note is that again also telling us that included in operating expenses. That means that 587 is also inclusive of the 5.6 and the 9.3 million. So that means that we also have to go ahead and remove the 5.6 million and the 9.3 million. I hope we are together. If you feel lost, let me know before I lose you totally. Okay, don't see any complaint yet or any question. So I want to believe we are on track. So when I add up this, I'm going to get my net operating expenses being 605. In case there's any other adjustment I need to make for my my general operating expenses, please feel free to let me know. So I'm going to clearly indicate that there. Next on our TB, we are saying, or they are telling us, when I say TB, I mean the trial balance. So next on our TB, we have administration costs. Let's see if there is any note that is going to affect our administration cost of 136,500. Professional expenses. Yeah, we had something to do with administration costs. So same thing, I'm going to do my note. How much my original administration cost? 136,500. I'm going to come here to my notes, get my 136,500. Okay, and see what the note was telling me. For general expenses, it was telling me do I have any adjustments to do with general expenses? These are admin, operating expenses, included in operating expenses. I don't think there was an adjustment with general expenses. Let me know if you see it, because I don't think I'm seeing it. Do we have any adjustments with our general expenses? Oh, sorry, their administration costs. Sorry, I've been calling them general expenses. Admin costs are 136,000. I saw adjustments to do with admin costs. Admin costs, they tell us that we have 31.2 million, which was paid in advance. So we know that by now, we know that when we have a prepayment, we are going to subtract. So how much was paid in advance? 31.2 million. So I'm going to come and show 31.2 million. So we know that when we pay in advance, it means that that money relates to the next accounting period. So when I add that up or subtract, I have my net admin expenses being 105,000. So I'm going to get my 105,000, take it to my report and show my admin expenses. So, okay, when we move on, what other operating expenses do we have? Accumulated depreciation, this doesn't affect our P&L. Additions and alterations to leasehold premises. So leasehold premises, like I told you, we amortize. So basically it's like depreciation. We are going to have to spread the cost over the particular period that they have told us. So for each year, we shall expense it just like we do with depreciation. So let's look at what the notes have to say about this addition and alteration. They're telling us, first of all, leasehold are to be amortized for a period over 50 years. That means that the useful life of this lease is 50 years. I saw another note here somewhere. For something to do with there was money that was used to get a lease permit or professional expenses were in respect to acquisition of leasehold premises. So just like how we got a total cost of a non-current asset, it's the same principle that we use for non-current assets that are intangible. We need to find the total cost of the asset and then we are going to depreciate it. So how much is the total cost of the asset? Here they've told us, in the notes they told us that professional expenses were in respect to acquisition of leasehold premises. That means that for us to get that lease, we paid some lawyers, and that remember the legal charges and all those things, we add them back to the initial cost of the asset for us to be able to get the total cost of the asset. So that means that the total value of the lease is 325,000 plus the 45,000, which are the professional expenses. I'm going to come to my book, my workings page. I will add 325,000 plus 45,500. I believe that should be correct. 325,000 plus 45,500. So this is the total cost of the lease. Cost of lease. And so when we amortize this total cost, when we amortize the total cost, I'm going to get the, sorry, pardon my, when I amortize, I'm going to get the cost of the lease, divide by the 50 years, that is the useful life of the lease. And that means that each year we will be spending 7,400 as the amortization value of the lease. Okay. Do we have, yeah, we have also, sorry, we had skipped out a figure. They told us we have the cost of leasehold. The leasehold premises cost us 1.3. We altered and made any additions to the lease for a cost of 325. And we then also incurred professional expenses of 45,000. So we also need to add this actual cost of the lease, which is 1,365,000. So I'm going to go back here and I'm going to add my 1,365,000. Yes, so when I add that up, I'll be able to get the cost of the lease. I hope you can see in my formula bar. I'll be able to get the cost of the lease plus the alteration plus the professional fees, which will give me the total value of the lease. And then I'll amortize that over the 50 years that they've told us are the useful years of the lease, which will give me as 34,710. And I'm going to come and show that in my working. And so I move on back to my TB. Back to my TB, where were we? We were on alteration of the lease. We have looked at professional expenses. These are drawings. We have cash and bank. Of course, these don't affect our P&L, so I'm just reading them out loud. And then we have our provision for doubtful debts. Now, the provision for doubtful debts is 6.5 or 6,500. In the notes here, they told us, if I could find the note that was affecting, note that was affecting, note 8, thank you. Note 8. Okay, bad and doubtful debts are treated as operating expenses. Bad debts of 10 million are to be written off. So before we go anywhere else, let's go and write off those bad debts of 10 million, because I told you when we are writing off bad debts, we shall expense the money that has been written off, which will be there as an expense. So that it reduces our profit, since in the previous period, we had a higher profit of 10 million. So now in the next period, we are making up for that loss that we have incurred. So we have shown that we have written off 10 million. We can continue reading our note. So bad debts of 10 million are to be written off. We have accounted for that, and provision for doubtful debts of 5% per annum was made. So how are we going to get the provision? We are going to get our total value of assets. So we're going to get our total value of receivables. Excuse me. So these are our receivables that we have in our TB, 267,800. I'm going to come and show that I have my receivables 267,800. I've shown that they've told us that we have written off 10,000. There is 10,000 that we didn't know. We didn't know that this person was going to pay us anymore, so we decided to write it off. What else happened with our provision? Sorry, what else happened with our bad debts? What else happened with our bad debts? I believe that was it that happened with with our bad debts. We already had our provision, but now they've told us that we should provide for 5%. So let's see how we are going to provide for that 5%. We have gotten our net receivables. We have gotten our net receivables by getting the total value of receivables minus the value that we wrote off. So when we when we subtract, we'll be able to get our net receivables being 257,800. So they have told us that we are going to provide now 5%. So we're going to get ours 5%, which is equivalent to 0.05 times our net receivables, which gives us 12,890. So 12,890. This is going to be our new provision. But now, remember, we already have a provision in the question. We already have a provision in our TB. Before we have been providing for doubtful debts and we have been providing 6.5. But now we are supposed to be providing 12.8. That means that we are increasing our provision all the way from 6.5 to 12.8. So how do we account for that difference? So because we're going to first get the difference, we're going to get the difference. First of all, we need to indicate the old provision. So when we subtract the new provision minus the old provision, we see that the provision increased by 6,390. And so we shall show in our expenses that our expenses are going to increase by 6,390, because now this provision is reducing our tentative profits. We were anticipating that people will pay us at least, we're anticipating that at least we shall make losses of only 6,500, but now it has increased all the way by 6.3. It has increased all the way to 12.8. So we need to reduce we need to increase our expenses by the increase. If the 5% that we had gotten, okay, was less than this 6.5, maybe let's say we calculated and turns out that the new provision is going to, the rate that we have gotten, the 5% of maybe the receivables is 6,000 and we had been providing for 6.5. It means that our provision is going to reduce. And that means that, yes, we're anticipating that we'll make a loss of 650 and we're ready to write it off as an expense. But now it seems like people will be paying us, and so we are going to increase our income. So we're going to show a tentative increase. And so in that case, we would have gotten the difference, which is the 6.5 minus the 3,000. And that means that our provision would have reduced by 3,500. This 3,500 would have been shown as an income in our statement. I hope we are together. Okay, so we are going to expense our increase in the provision, which is a 6,390. 6,390. Clearly, we're going to show our increase in provision being that. So moving on, we now look at our depreciation. We have looked at admin costs. We have looked at provision for doubtful debts. I believe we can now depreciate. So they told us in the notes, leasehold is to be amortized for 50 years. Furniture and fittings, 10%, and equipment is at 20% on cost, respectively. So I can just get 10%. I can just go and look at furniture and fittings here. Furniture and fittings, this is accumulated depreciation. I need to know the cost of the furniture and fittings, which is 272. Furniture and fittings, 272 times the 10%. 10%, 200 for furniture and fittings. I've told us that it's 10% on cost and equipment is 20% on cost. So that is basically straight line, just the way you're hearing it. So I'll multiply my 10% for furniture and fittings, which will give me 27,200, and the 20% on equipment at cost will be 39,200. So that will be how I'll look at my expenses. When I add them up, how much should I have? How much should my general operating expenses be? Someone tell me how much the value is for the operating expenses. These are it. This has 1.49. Anyone else? Seems like the majority has that. Let me first check with mine. Okay, we seem to all agree. 1,496,200 shillings. So my total operating expense will be that. So when I get my operating expense, offset it against my gross profit, I have a net profit of 678,500 shillings. So now that I've gotten my profit, I can now appropriate. I'll start with getting my profit and loss appropriation account. So of course, I will show that I have my balance brought forward, which will be, of course, the net profit that I got in the previous period. If it's a loss, you will do exactly the same. Just that a loss, of course, is going to affect their reserve. That is the reserve of the retained earnings, like we shall see how the current accounts are going to look like. So just as according to the pro forma, we shall get the interest on capital. Now, the note was telling us, the question was telling us, partnership agreement provides that partners are credited at the end of each year with 5% on the balances of their respective capital accounts at the beginning of each financial year. So they mean you're supposed to give partners interest. You're supposed to receive interest on capital, and this interest will be inflated upon the opening balances of their capital. So what the question is trying to tell us, which are these amounts that we have. So we're going to get 5% of this 1 million, 5% of the 650, and 5% of the 390. So we shall clearly show for Debbie, Samson, and Martha, they are 5%. 5% of 1,040,000 should be 52,000. 5% of 650 should be 32. 5% of 390 should be 19,000. So this interest on capital will reduce the net profits that they're supposed to be receiving. And then after that, can now pay them their money. Remember this money here. This money here, we can now give it to the partners. We are not supposed to include it in our P&L, but we are supposed to include it in our profit appropriation account. So I'm going to give that money to the partners. I'm going to clearly show Debbie's salary, Martha's salary, and Samson's salary. When I multiply their monthly salaries, for Debbie, I get 78,000. For Martha, I get 46,800. And for Samson, I get 39,000. When I add this up, of course, it will give me the 163 that we had gotten. So we don't have anything like drawings in this question. I want to believe so. They said that there are no drawings. I saw somewhere in the note them saying that they don't have no interest in charge. Okay, it was no interest in charged on drawings. Do we have anything like drawings in the question? Someone let me know when you see them. I personally do not see them, so I'm going to move forward, but in case you see them, let me know, please. So now that, yes,
They are there.
how much are the
Okay.
drawings?
Debbie has 91,000.
Oh, okay, I've seen them.
Mm.
Okay, thank you. So we have our drawings here, but our drawings are not going to affect if we can just go back to our pro forma just to confirm our profit appropriation account. we have interest on drawings. Interest on drawings is what affects the profit and loss appropriation account, but the drawings it's themselves affect the current account. And so the notes say that we don't charge interest on drawings. So that means that the value for the drawings is we're going to look at it when we look at our current account. That is going to be part of the next question, part B of the question. If we had just refer back to the pro forma, for this question, we were given partner salaries and interest on capital. We're not given interest on drawing. So we have entered this, we have entered the interest on capital. The next part for us is to get our residual profit. How do we get our residual profit? By subtracting the partner salaries and the interest on capital from the net profit that we had earlier gotten. So when I add up this 1,004 and I add up that 163, I am able to get 267, which I will offset against my net, profit. And that is going to give me a residual profit of 410,000. Sorry, 410,700 shillings. So now that I've gotten my residual profits, I can now allocate this money to the people, to the partners. Let's go back and find out what their profit sharing ratio is. Usually this profit sharing ratio will be given up here in the question. They told us that they share 4 to 3 to 3 respectively. That means that Debbie picks 4, Martha picks 3, Samson picks 3. And so for us to know how to calculate this, we are going to get our 4 plus 3 plus 3. That means that the total share is 10. 6 plus 3, that's 6 plus 4, that's 10. So that means that Debbie gets 4 out of 10, Martha gets 3 out of 10, and Samson gets 3 out of 10 of a share of profit. And so we are going to get, we're going to come and show our share of profit with Debbie getting 4 out of 10, which is equivalent to 164. Martha getting 3 out of 10, which is equivalent to 123. And then Samson getting 3 out of 10 of the profit, which is also equivalent to 123. So of course, when you balance these off, when you add these up, they should still be able to give us the 410 because we're just allocating this 410. So when we add them up, 164 plus 123 plus 123, we should be able to get a total of 410. And that's how we appropriate our profits. Do we have any question on this part of the question? Do you have any question? Are we together? Okay, I will take it that silence means that everyone is okay. Please, if you're waiting for the recorded lecture so that you can understand, it's best you try to ask from here so that we can understand from here. Okay, moving on, the second part of the question asked us for a current account. They asked us to calculate the current account. I might just take you down there. They told us to calculate the partner's current accounts. Okay, so we'll draw our T account, show our debit side and our credit side. So for every partner, remember I told you every partner is supposed to individually show what is happening to them. So we will show Debbie, Martha, Samson, we'll create their accounts for them. And of course, we'll show their the currencies, the monies are in and the level of precision. This will happen both on the debit and the credit side. So now we can start. It's the current account. So we are going to put things that relate to a current account. I think I saw opening balances of current accounts here. Let me just pick them. Those ones we can copy and paste. Current accounts opening balances, we had Debbie with 208, Martha with 156, and Samson with 104. So I'm going to come and show my balance carried forward. For Debbie, we had 208. For Debbie, we had 208. Excuse my French. For Martha, we had 156. And for Samson, we had 104. So we are basically, excuse me. We are basically going to pick some of these items from the profit appropriation account. So let's start. We have interest on capital. Interest on capital, this is how it was shown. We are going to come and show our interest on capital on the credit side. So that means that the money that these people ideally are supposed to be receiving is increasing. Debbie had 52,000, Martha had 32.5, and Samson had 19.5. So next on the appropriation, we had partners' salaries. We're going to come and show partners' salaries. Those are the salaries. So basically, this account is just ideally so you're now showing how much the person is going to take home. Like if we were to bank this money, we are now showing how much it will be. So the salaries, Debbie was paid 78. Martha was paid 46.8. And Samson was paid 39,000. And then after that, we also shared profits for them. We gave them the residual profit. So if we are to give them also more money, this would be the money that we would be giving them. So Debbie, we're going to come and show our share of profits. Debbie received 164,000. Martha received 123. And Samson also received 123. So ideally, this is the money they're supposed to be totally receiving. But remember, you guys have told me we have drawings. So we are going to go back and now we're going to now go back to adjust that money and see what is going to reduce it. So we come back to our question. Debbie has drawings of 91, Martha has drawings of 78, and Samson has drawings of 52,000. So ideally, if we are to give them all this money, like if maybe at the end of the year we have calculated this was a balance brought forward in that current account, they earned the interest of capital that, and we pay them salaries of this and shares of profit. Ideally, all this money, like we are assuming we are supposed to give it to them as cash. Maybe we have decided that we want to give them as cash. This would be the total money that they will be receiving, but that money will be reduced by the drawing. So before we give them that money, we have to first offset the drawings. Martha picked 91,000 from the business. Sorry, Debbie picked 91,000, Martha picked 78, and Samson picked 52. So those are the things that will affect the current account. So when we balance it off, for Debbie, when we add up that, we'll have a cumulative total of 502. Martha will have a cumulative total of 358, and Samson will have a cumulative total of 385. So in the event that we're supposed to pay off these people's money, okay, would balance them. So just like we have been balancing, I'm going to show you, and I'm using this this scenario in the event that, because if we are dissolving the partnership and we actually decided to give people cash, then we would balance off. Yes, Debbie was supposed to receive 502,000, but she had drawings of 91, meaning that her net balance would be 411. That means that if we were to give her cash, we would debit her bank or would deposit in her bank this much money. And Martha We also balance off Martha's account. 358 minus 78 gives us 280. And then we also balance off Samson's account, 285 minus 52, which gives us 233. So this will be the balance carried forward for their current accounts. So you see in the period, in the last year that has ended, they started off, for example, Debbie started off with 208, but in the next year, she's going to start off with 410. It means that her value as a shareholder is increasing. If she decided to leave the business on that day, or if she decided next year, like, guys, I'm tired of working with you, they have to give her this money that is in her current account. If they decided to dissolve the partnership. When I talk about dissolve, they decided to all go their separate ways. Then each person, this is the money that they would receive. This money here, this one, the balance carried forward. So that introduces me to dissolving of partnerships or adjustments in partnerships. Do we have any questions? We'll be looking at those adjustments next week. We'll look at what happens when we onboard a new partner, what happens when one partner leaves, what happens when a partner dies, what happens when we close a partnership. But for now, this is the basic reporting for partnership. So in case you're asked to also create a capital account, you will just do this same template and you will bring forward the capital balances, these ones here. These capital accounts, you will just bring forward this. Okay, then in case, of course, you can actually even teach, you can use this question for more practice on the statement of financial position by going ahead to create the statement of financial position. Usually they will not ask you on partnership accounts, they will rarely ask you for it, but you can still go ahead and just do it for practice sake. Do we have any questions?
Yeah, I have a comment.
Yes, Lily.
So I was looking at this drawing account, and I'm in disagreement that it is a liability, because this account, when you look at it, when it receives money, it's debited. And when a liability receives money, it's credited. So I was like, it's not a liability.
Drawing is not a liability.
Because if we say cash drawing, then here drawing is receiving and cash is losing. And by drawing receiving, it is debited instead of being credited. I thought if it was a liability, by receiving it could be credited, which is the best part.
In the current account, you've seen it being debited.
Yeah.
Okay. This is not a drawings account. This is a current account. So in the current
let me assume. If I say cash drawings, what is the double entry?
Okay. When you draw cash, of course you're getting more cash. Okay. So you will debit cash, you will credit the drawings.
When I draw cash. Okay. I was wrong.
Okay. Do we have any question? Okay, apologies once again for coming in late. I got a bit stuck in traffic. Please read through the notes and let me know in case you find a challenging question with partnerships. Partnerships are one of the topics that you can do and practice and actually get good at, and it's a very, very easy number to do when you're very good at it. In as much as it looks like it's lengthy right now, but it's a bit straightforward. So practice, reach out in case you have any questions. There is someone who was asking me about shares. That is a whole different topic, and we shall look at it after we looked at partnerships. So thank you for your attendance. Thank you for being a good class and have a good night.
Excuse me.
Yes, please.
I have a suggestion. Is it okay we start the lesson at 7 p.m. because of the jam and all that? I don't know
That
what
will,
my friends suggest.
that will have to be a unanimous decision amongst your colleagues. You guys can decide and then you let me know.
No, it does not favor us.
Okay. Okay, you will decide and let me know. I don't mind adjusting a bit because I also face jam, but we need everyone to agree. I don't mind 6:30. I don't mind 7. So either way is okay with me. You guys discuss amongst yourselves. Vote if you need to and let me know.
But before you leave,
Mm,
when I draw cash,
mm.
I'm losing cash, not so?
No.
When I draw cash, I'm receiving cash.
Yes, you're getting cash because you actually get the money.
Yeah, okay,
Just
good.
that you're picking it from the business. So it's the business that is losing. Mm.
Night.
Okay, good night.
The solution.
Oh, let me send it.
Okay, thank you.